Hi everyone, I'm Lisa and my team members are showed below. Today our team will talk about On, a Swiss running brand. Here are contents we will cover. First, I will start with history and background. This brand begins with Olivier Bernhard, a retired runner. He didn't like normal shoes. He wanted something new and light. So he took a garden hose, cut it, and glued it to a shoe, just like this picture. That's how Cloud Tech started. It is soft when you land, but strong when you push it. 2010, On is born in Zurich. First test shoes are made. 2012, they sell the Cloud Racer shoe. Swiss runners wear it at the Olympics. People love it. 2013 to 2018, On grows. They sell in Europe, then to the USA. 2019, Roger Federer joins. He gives money and helps design. That year, On has 40% of running shoes in Switzerland, 10% in Germany. 2020, they make the Roger snake for daily wear. It sells a lot. They also start selling clothes. On has 6,000 stores, and that's in 55 countries. In USA, it is its biggest single market. In the world, they have 2% of all sports shoes. So, in 2021, On goes to the New York Stock Exchange. They raised 858 million US dollars. It is one of the biggest Swiss IPOs in history. 2023, they buy their R&D lab full-time. Also, they grew in trail running and tennis. Recent years, On becomes the official shoe of Ironman World Championship and launches Cloud Monster 2 and Cloud Boom. From a garden hose to the world, On is the one who are fighting Nike and Adidas now. How they did it? Later, my team member will introduce this company more.
Thanks, Lisa, for the On Holding company's development information. Hello, everyone. This is Qinglan. Next, I will focus on explore a reason how a Swiss brand suddenly became a global giant. Well, from my slide, you can see that they keep their product line quite simple and focus on three main area. First is performance footwear, and second is apparel or sports clothing. Third is accessory, like some tennis hats. This is driving impressive results. In the second quarter of this year, the company reported sales of about 749 million Swiss francs. Looking at their recent Q2 and last year report, we see a clear story where their main revenue source is from the footwear. The most exciting growth is actually happening in apparel last year, and also this kind of growth is keep increasing. You can see these two figures. Secondly, their entire business is built on their own unique technology and innovation. They create and sell sports products worldwide that features their special patented system like the Cloud Tech and Speedboard. This is what creates the unique on-cloud feeling that sets their brand standing out. Thirdly, their market strategy is sharply defined, premium through a modern and direct-to-consumer approach or D2C approach. This model actually nowadays favored by many leading luxury brands is crucial. It's not only secure high profit margin, but more importantly, build a direct and valuable relationship with their customer community. For On, this channel is unfair, and this kind of growth is not happening in one place. It's happening in worldwide. This is why their sales revenue is growth like a rocket. Growth roadmap is clear. They are positioned to capture key opportunity, like booming the market from the Latin American, the woman segment, and through e-commerce. However, their pace forward is shadowed by two significant risks. First is their fragile supply chain. They heavily relies on a limited number of third-party manufacturers, makes them highly vulnerable. We know that any hiccup from the supply chain could lead to a big problem. Second is a growing threat of the product or fake product in local. As they become brand more popular, so many fake products flooding the market. This kind of thing stolen their sales revenue and also ruin their brand image and product quality, and also the customer trust. So the ability to navigate this kind of specific risk will be a major determinant of their future success. But On's ownership structure is also a key strategic asset. It's an independent public trade company, but control remains firmly by their three co-founders. This co-founder-led stability is absolutely crucial as they navigate the opportunities and risk from our earlier SWOT analysis. Their explosive growth in APAC, a robust financial engine, achieving an adjusted EBITDA margin of 22.6%. On the chart, you can see many agents have this kind of data. They said that in the next 2 years, their expected sales revenue will over 30%. In summary, On's market prospects are exceptionally strong, but its ability to margin inherent in the supply chain risk will be the ultimate test of its resilient financial and ownership structure. Okay, that's all my reports. Next, give the show time to Zoe. Thank you.
Thanks, Lena. I'm Zoe. In this part, I will walk through On Holdings' organization structure and explain how the company's operating model supports its global expansion. To begin with, On operates as an independent, publicly listed company headquartered in Zurich. Unlike many competitors that belong to large consumer groups, On remains an independent structure, which allows the founders and management to maintain strong strategic control and agility. Look at the three-tier operating model, which is at the center of how the company runs. First, the global headquarters in Zurich acts as the strategic brain of the company. It manages brand strategy, product innovation, financial governance, and the consolidated reporting. This centralization ensures consistency in branding, innovation, and quality across all markets. Second, The company organizes its operation into three major regional divisions: US, EMEA, APAC. These regional teams execute market strategy, manage local supply chains, and adapt product and marketing decisions to regional needs. For example, APAC focuses more on rapid expansion and market entry, while the US focus on D2C growth and brand partnerships. Third, On relies on an extensive outsourced manufacturing network, mainly across Vietnam, China, and Indonesia. This is part of On's asset-light business model, which reduces capital requirements, increase flexibility, and allows the company to scale quickly without owning factories. However, this structure also brings challenges because production is outsourced. On must maintain strong supply chain financial controls, especially in forecasting, inventory management, and quality assurance. To manage risks, On works with long-term contract manufacturer and diversifies across multiple locations, similar to Nike and Adidas' metric supply chain model. Overall, On's organizational structure balances centralized strategic control with regional execution and flexible manufacturing. This combination enables the company to scale rapidly while staying innovative and financially disciplined. Now I'll move to the leadership and governance framework. On presents a unique combination of founder-led vision and professional management discipline, which is a key driver of the company's long-term success. Let me start with the executive leadership team. The brand is still strongly shaped by its three core founders, Casper, David, and Olivier. Three of them are all co-founders. Casper is leading the brand strategy, global marketing, and estates partnerships. David is responsible for product creation, design, and customer experience. He also plays a major role in driving direct-to-consumer expansion. Olivier is the co-founder and executive board member. He is also a former professional athlete who ensures that performance innovation remains at the core of product DNA. Together, the three founders maintain strategic continuity and innovation culture even after the company became publicly listed. In 2025, Martin became the sole CEO. He brings a more institutional and operational management style, ensuring financial discipline, scalable operations, and sustainable growth. This founder plus professional structure helps balance creativity with execution. Look at the governance strengths. First, On benefits from a collaborative leadership model. The founders remain deeply involved in the strategic areas, ensuring long-term direction rather than short-term financial pressure. Second, the company has strong incentive alignment because the founders and the board still hold a large portion of voting rights. Their interests are closely tied to shareholders and long-term value creation. Third, there is a clear performance accountability. Management compensation is linked to revenue growth, EBITDA targets, and increasingly to ESG performance. This reinforces disciplined capital allocation and sustainable business practice. In summary, On's leadership framework combines entrepreneurial energy, with institutional governance, allows the company to innovate while scaling in a financially sustainable way. That's all my part. Now I'll hand over to my teammate. Thank you.
Hi, this is Zia. Here I will cover On Holding AGs in two parts, the capital structure and the capital raising policy. I will start with the balance sheet and liquidity, move to equity and voting control, and finish with the IPO, facilities, and my bill. I made these two diagrams to show On's capital structure more clearly. According to the 2024 annual report, On statement of financial position shows total asset of 2,376.7 million Swiss francs, total liabilities of 984.9 million Swiss francs, and shareholders' equity of 1,391.8 million Swiss francs. Current assets was 1,759.7 million Swiss francs, including cash and cash involvement of 924.3 million Swiss francs. In simple terms, the capital mix is about 16% equity and 40% liabilities, and cash alone almost cover total liabilities. This points to low leverage and strong liquidity. The company's debt-like obligation mainly come from IFRS 16 lease liabilities, plus a small amount of other financial liabilities. At the year end of 2024, lease liability total 347.6 million Swiss francs, and other financial liabilities was 53.1 million Swiss francs. Together, they were 400.7 million Swiss francs, or about 14% of total liabilities and less than 17% of total assets. On a capital basis, debt divided by debt plus equity was 22%, which is light leverage. Based on cash and those debt-like items, net cash was 524 million Swiss francs. Liquidity coverage is strong. The current ratio was about 2.66, the CRIP ratio about 1.86, and the cash ratio about 1.40. The constructual maturity analysis show cash outflows very smoothly over less than 1 year, 1 to 5 years, and beyond 5 years, with no large bank loans or bonds maturing at one time, so refinancing and interest rates risk looks limited. On Holding AG also maintains a multi-currency revolving credit facilities of 700 million Swiss francs with an accordion option. As of year end of 2024, it was undrawn. It supports liquidity for general corporate purpose, guarantees, and letter of credit, without adding balance sheet up. With this foundation, let's see who holds control and what it implies for the capital structure. On has no preference shares or hybrid capital instruments. Share capital consists of two classes of ordinary shares: Class A ordinary shares, which were listed, and Class B voting right share, which were not listed. Treasury shares are held within Class A. The founder team and senior management held all Class B and some Class A, which given them about 59.8% of total voting power and about 19.7% of the economic interest. During the reporting period, the company did not repurchase shares. Changes in equity mainly came through share-based payment and small increase in share capital, with movement recording through capital research and return earnings. Now that we know the structure, let's move to how the company raised capital. The key external financing event was the IPO on September 15, 2021 on the New York Stock Exchange at USD 24 per share, with about 35.8 million shares issued and approximately USD 858 million in group process. The use of process focused on strengthening the capital base, working capital, and capital expenditures. Since then, ON has not disclosed a target leverage ratio or a fixed dividend policy. Share capital changes has been driven mainly by share-based payment, not by underwriting follow-on offerings. Putting this point together, ON's financing approach is clear. The first, daily operating and expansion are funded mainly by operating cash flow and equity, not by large amount of interest-bearing debt. Second, long-term leaves support the global retail and logistic network while conventional borrowing remain minimal. And third, a sizable undrawn revolving facility is kept in reserve to provide rapid funding flexibility if needed. The mix support high growth investment while maintaining a strong safety margin and flexibility.
So first, let's look at the payout policy. In simple terms, the company does not distribute dividends to the shareholders. So we want to know the underlying reason why there's no dividend payment across this years, and we're using the annual report to analyze. So firstly, I think it's quite obvious because the company has only listed for more than 4 years, and it's quite common for company during this stage to do not pay out dividend. But we are going to look into more details. So firstly, I think the primary reason, if you look at the income statement, is the instability of net sales. So the company is experiencing an explosive revenue expansion. So net sales have surged dramatically in recent years. If you look back at 2019, the data here, and the most recent report in 2025, the net sales has increased for approximately 10 times, which indicates that the company is still in the expansion phase. Therefore, I think the company would like to reinvest all of the earnings back into the operation and marketing and expansion side. And also, in the early years, the company reported a negative net income, so which turned to be positive in 2022, as we can see on the right bottom of the table. So even the profitability has improved. I think the expenditure to areas like opening new stores and applying aggressive marketing strategy. Well, obviously, these strategies allow company to survive in a competitive market, but it makes the dividend payout more impractical. So for investors and shareholders, I think we might expect the return primarily from the capital gain, which is holding the stock and selling the stock at a high price and benefiting from the stock price increases as the company grows larger and larger. One holding is one of the fastest growing company in the industry. So the gross profit margin in the most recent report exceeds 60%. So I think once it enters a more stable and more mature period, like Nike has today, I think the company could potentially introduce dividends and to attract more outside investors. So next, let's look at the investment policy. The company has no history of public acquisitions, so no M&As, and no direct investment shows in the announcement. So we calculated the incremental cash flow, and we can see in 2024, the net capital spending and change in net working capital has increased dramatically. So if we look back at the balance sheet, the total assets has increased for around 50% in 2024 comparing to the former year. So the company holds cash, mainly holds cash, followed by inventories, right-of-use assets, trade receivables, and then the PPE, property, plant, and equipment. So if you look at the liability side, then other current operating liabilities and non-current lease liabilities account for the most. So this data indicates that the company is focusing on expansion worldwide, like opening new stores and having new warehouses. So the company focuses more on the internal growth instead of doing acquisitions to have or integration for expansion. So also, as our member talked before, more than 30% of the revenue generated from non-US market. So if you look at the foreign exchange gain or loss, it fluctuates a lot. So this also indicates that the company really need a stable international environment, which has been unstable in recent years. So first the pandemic, then the trade war. So this leads to a heightened focus on mitigating the risk. So this also emphasized that the company really need for the internal stability. So they focused more on the internal growth instead of the risky acquisitions. So this is our references. And to wrap up the whole presentation, we think the company has sufficient technologies and is experiencing a rapid expansion. So our group think that we are quite optimistic that the company will capture more market within the industry in the world and to achieve continuous growth in the future. Thank you.